A luxury hotel can sell every room tonight, fill the restaurant, charge $45 for breakfast, and still lose money for the person who owns the building. From the sidewalk, that sounds impossible. The valet lane is blocked. The lobby bar is full. A wedding is taking over the ballroom. Guests are paying $600 for rooms that will be empty again by 11 tomorrow morning. You look at that building and think, 300 rooms, almost no vacancies, premium prices, this place must be printing money. But the crowded lobby is showing you revenue. It is not showing you who receives it, who controls it, or what has already been promised to everyone else. The name above the entrance may belong to a global hotel brand. The staff may be directed by a separate management company. The land, mortgage, insurance, renovations, and final financial risk may belong to an entirely different owner. A professionally managed luxury hotel is not one business. It is several businesses stacked inside one very expensive building. And the party that owns the building is often the last one to get paid. By the end of this breakdown, the hotel's revenue will pass through a complete financial waterfall, from room rate to brand fee, from payroll to renovation reserve, and finally to debt. The surprising part is not that luxury hotels are expensive to run. It is that the building can perform well for the guest, the brand, and the operator while producing a terrible result for the owner. To understand why a full hotel can lose money, start with the structure. At one end is the independent owner-operator. The same group owns the property, hires the staff, controls the brand, and keeps whatever remains. Then there is the franchised hotel. The owner pays to use a famous flag, plugs into its reservation and loyalty systems, and usually hires an operator to run the property. Then there is the brand-managed hotel. The owner supplies the real estate and capital, while a company such as Marriott, Hilton, Hyatt, or Four Seasons manages the operation under a long contract. The guest sees one hotel. Financially, the building may contain an owner, a lender, a brand, a manager, a loyalty platform, online travel agencies, restaurants, retailers, and event contractors, all taking money from the same stay. That distinction is not a technical detail. It is the business model. Large hotel brands increasingly make money by collecting fees from properties they do not own. Marriott reported about $5.4 billion in gross fee revenue in 2025, compared with roughly $1.7 billion from owned, leased, and other operations. Hilton describes the same basic split. Third-party owners carry the hotels, while Hilton earns management and franchise fees from the system. The visible business is hospitality. The scalable business is contracts. The capital-intensive business is ownership. Before the first guest complains about the pillows, the owner has already made a giant bet. A luxury hotel is not an apartment building with nicer furniture. It needs commercial kitchens, ballrooms, elevators, laundry systems, loading docks, staff areas, spas, pools, security systems, backup power, and public spaces that must look expensive even when nobody is paying to stand inside them. HVS's 2026 United States Development Survey recorded a median luxury hotel development cost of more than $1.6 million per room in its sample. That figure is not a universal price tag, but it shows the scale of the category. At that level, a 300-room project is not a $60 million hotel. It is approaching a $500 million real estate decision. And unlike an office building, the product must be rebuilt continuously. Carpets fade. Bathrooms date. Mattresses wear out. Restaurants lose relevance. A lobby that looked timeless 10 years ago suddenly looks like an airport lounge from another era. The owner does not finish paying when construction ends. Construction is merely the first renovation cycle. Now add the brand. A major flag can bring global reservations, corporate accounts, loyalty members, pricing systems, and trust. For a luxury property, That distribution can be the difference between a landmark and an empty monument. But the flag is not free. Marriott says its franchise royalties generally run from 4 to 7% of room revenue, with some brands also charging on food and beverage revenue, plus reimbursements for centralized systems such as reservations, loyalty, and marketing. Under management agreements, the operator usually receives a base fee tied to hotel revenue and an incentive fee tied to profit. Public hotel owners disclose base management fees around 2 to 4% of gross revenue in some contracts. Notice the asymmetry. A base fee can rise when revenue rises, even if the owner's final return is weak. The manager may be performing exactly as contracted, while debt service, property taxes, insurance, and capital spending erase the owner's profit below the operating line. The operator manages the hotel. The owner owns the consequences, and these relationships can last decades. Marriott says many management agreements begin with terms of 20 to 30 years, often with renewal options. Signing the wrong agreement can outlive the executive who signed it. Luxury hotels are also unusually dependent on the exact type of demand surrounding them. A resort sells weather, scenery, and leisure time. An urban luxury hotel may depend on corporate travel, conventions, international visitors, weddings, and high-end dining. An airport hotel sells convenience. A convention hotel can look brilliant during one citywide event and strangely oversized the following week. Two buildings with the same room count and the same brand can therefore be completely different investments. The key is not simply how many people visit the city. It is who arrives, why they arrive, how far ahead they book, what they are willing to pay, and whether the hotel fills on Tuesday as well as Saturday. A luxury hotel cannot store tonight's unsold room and sell it next month. At midnight, the inventory expires. That makes the business a daily auction conducted against a fixed building and a mostly fixed cost base. This is where full becomes misleading. Hotel owners track occupancy, but occupancy alone does not tell them whether the building is healthy. A 90% full hotel charging $600 can produce less room revenue than a 75% full hotel charging $800. That is why the industry uses RevPAR, revenue per available room. It combines occupancy and average daily rate into one number. But even RevPAR does not show the entire owner return. A hotel can raise room revenue while losing ground after labor, utilities, insurance, management fees, renovation reserves, and interest. And discounting rooms to create the appearance of fullness can make the problem worse. Every occupied luxury room creates work. Someone cleans it. Someone checks the minibar. Someone washes the sheets. Someone answers the late-night call about the air conditioning. Someone replaces the amenities, carries the bags, parks the car, maintains the flowers, and staffs the breakfast room before sunrise. A budget gym likes customers who keep paying and stop arriving. A luxury hotel has the opposite problem. There are no profitable ghost guests. Every guest consumes the product. Rooms are still the economic center because, once the hotel is operating, an additional room night can produce attractive contribution margin. But luxury properties are designed to extract more value from each guest and from people who never sleep there. Restaurants and bars create traffic. Ballrooms convert empty floor area into weddings, conferences, and corporate events. Spas, parking, resort fees, retail, suites, room upgrades, and branded residences can deepen the revenue pool. Yet not all revenue is equally valuable. A crowded restaurant may look impressive while labor and food costs consume much of the sale. Seabury found that labor represented 59.4% of food and beverage departmental expenses in its 2025 hotel sample. A banquet can produce strong revenue, but it also demands kitchens, servers, setup crews, linens, utilities, and large spaces that sit idle between events. The owner therefore cares about the mix, not just the total. $1 from a high-rate room is not the same as $1 from a labor-heavy dinner. And a hotel that chases every possible revenue stream can become operationally busy without becoming financially better. Then comes the expense that rarely appears in a guest's mental calculation. The building must remain luxurious. Hotel management agreements commonly require an FF&E reserve, money set aside for furniture, fixtures, and equipment, often around 3 to 5% of total revenue, with luxury hotels tending toward the higher end. That reserve is not optional savings for a distant future. It is the economic recognition that the asset is wearing out every night. And sometimes, the reserve is not enough. Brand standards can require room renovations, new technology, redesigned restaurants, upgraded bathrooms, or a complete lobby transformation. These projects may protect the brand and future room rate, but the owner usually funds them. Host Hotels and Resorts offered a sharp example in 2026. It sold the St. Regis Houston for $51 million after estimating that the hotel would need roughly $49 million of capital expenditure over the next 5 years. The sale price and the expected renovation burden were almost the same number. That is what luxury ownership can look like from behind the marble. Debt turns this operating challenge into a survival challenge. In San Francisco, Park Hotels and Resorts stopped payments on a $725 million non-recourse mortgage secured by the 1,921-room Hilton San Francisco Union Square and the 1,024-room Park 55. The hotels entered receivership in 2023, and the receiver sold them in November 2025, with the buyer assuming the loan. The hotels did not disappear. The Hilton signs did not prove the owner's investment was safe. The operating business, the brand relationship, and the real estate financing produced different outcomes for different parties. That is the central danger in professionally managed hotels. The property can remain open, employ hundreds of people, host thousands of guests, and still fail as an investment for the capital owner. The owner's equation is not rooms sold multiplied by room price equals profit. It is closer to this: room revenue plus food, beverage, events, and other income, minus departmental expenses, payroll, utilities, sales, maintenance, management fees, franchise and system charges, minus the FF&E reserve, property taxes, insurance, debt service, and owner-funded capital projects. What survives that waterfall belongs to the owner. Consider a simplified 300-room luxury hotel. At 90% occupancy and a $600 average room rate, it sells 98,550 room nights and generates about $59 million in room revenue. Add $25 million from restaurants, bars, events, parking, spa, and other services. The hotel now reports roughly $84 million in annual revenue. That sounds extraordinary. Now assume the operation consumes $60 million through labor, departmental costs, utilities, maintenance, marketing, and management. About $24 million remains before major ownership costs. Set aside 5% of revenue for FF&E, roughly $4.2 million. Add $4 million for property taxes, insurance, and other ownership expenses. Then add $18 million of annual debt service on a heavily financed development. The nearly full hotel is now losing more than $2 million before any surprise renovation, lawsuit, storm damage, or construction disruption. These are illustrative assumptions, not an industry average. But the mechanism is real. Occupancy filled the building. The capital structure emptied the profit. Good hotel versus bad hotel. Now compare two owners. The strong owner enters at a sensible property value, uses less debt, negotiates an owner priority return before large incentive fees, funds renovations before the hotel looks tired, and protects rate rather than buying occupancy with discounts. The property may run at 75 or 80% occupancy, but its guests pay more, its group business is profitable, and its cash flow can survive a weak quarter. The weak owner overpays during a travel boom, finances aggressively, accepts a long contract with limited control, delays renovation, and then cuts rates to keep the rooms full. The lobby stays crowded. Revenue may even rise. But labor rises, fees rise, interest remains fixed, and the next mandatory renovation arrives before the previous debt has been reduced. The difference between the two hotels is not service quality alone. It is who owns the building, what they paid, how the contracts divide the revenue, and how much capital sits ahead of them in the payment line. A luxury hotel room may be rented one night at a time. The business is locked in for decades. The brand can earn from the system. The manager can earn from revenue and operating performance. The lender receives scheduled payments. Guests receive the experience they purchased. The owner receives whatever is left. So the next time you see a luxury hotel with a full lobby and no vacancies, do not ask how many rooms it sold. Ask how much of each room was already promised before the guest arrived. Because a full hotel is proof that the operation is busy. It is not proof that the owner is making money.